Most people watch their portfolios bleed and ask, "Where did my money go?" But they're asking the wrong question. In this system, wealth is never truly deleted, it's only relocated. Today, we're looking past the red charts to find the hidden exit doors. I'll show you why a market crash isn't the end of wealth, it's the beginning of transfer season. I'm Stickman, this is Void Analysis. Let's find out who's really holding the cash when the dust settles. Every time the stock market crashes, the same kind of headline floods your screen. $3 trillion wiped out of global markets. It sounds catastrophic, almost supernatural, as if some invisible force reached down from the sky, erased a few trillion dollars from existence, and left investors staring at empty portfolios. Charts turn red, numbers collapse. Your account balance looks like it just went through a shredder. But there's a question almost nobody asks, and it's the most important question in the entire financial system. Where did that wealth actually go? Because according to the basic laws of both physics and economics, something strange happens here. Nothing appears out of thin air, and almost nothing truly disappears either. Value doesn't simply vanish. It changes form. Before we dive deeper, quick disclaimer, I'm not giving financial advice. I'm just your narrator, your friendly stickman guide through this strange financial labyrinth. I'm not here to tell you what to buy or sell. I'm here to show you how the maze itself moves. Most people imagine the stock market like a giant underground vault. Inside the vault, mountains of cash. Stocks go up, more money appears in the vault. Stocks go down, money disappears from the vault. But that's not how markets work at all. The stock market is closer to a constantly updating scoreboard. Every few seconds, a tiny transaction happens somewhere on the planet. One buyer, one seller, one agreed price. That single transaction instantly becomes the reference price for millions of shares. Let's imagine something simple. Stickman collectibles. There are exactly 1 million limited edition Stickman figures in the world. Yesterday, one collector bought a single figure for $100. Suddenly, every other identical Stickman figure is now considered to be worth $100 too. On paper, the market just created $100 million of value. But now imagine this. Tomorrow, one nervous collector sells theirs for $10. Nothing else changed. Same toys, same collectors, same number of figures. Yet suddenly the market value of the entire collection drops to $10 million. Did $90 million physically exist somewhere and then disappear? No. It never sat in a vault. It existed as an expectation, a shared belief about what someone else might pay. The stock market isn't a storage container for money. It's a constantly changing agreement about price. When prices fall, money doesn't evaporate. What actually falls is confidence in the future price of that asset. Now, let's talk about something far more powerful than stock prices. Something most people never see. The hidden engine behind bull markets. I call it ghost liquidity. During a bull market, something psychological happens across the entire economy. People feel richer. Your house price goes up. Your stock portfolio grows. Your retirement account looks healthier. And because your balance sheet looks stronger, something important happens. Banks are suddenly much more willing to lend you money. Your rising assets become collateral, and that collateral unlocks credit. Here's the crucial point. Most of the money flowing through the financial system is not physical cash. It's credit. Borrowed purchasing power. When markets rise, the financial system effectively pulls spending power from the future and uses it today. Loans expand. Investment increases. Businesses hire more people. The economy accelerates. But when markets fall, that process reverses. Collateral shrinks. Credit tightens. Borrowing capacity disappears. So when headlines say trillions were wiped out, What's really happening is something quieter but far more important. The system's credit-creating ability collapses. The money wasn't deleted. The capacity to borrow against future value simply shrank. In other words, the system ran low on trust fuel. Here's another strange property of markets. Prices rarely move symmetrically. Going up usually feels slow. Going down feels like falling down an elevator shaft. Why? Because markets rely on something fragile called liquidity. Liquidity simply means how easy it is to find someone willing to take the other side of your trade. During calm markets, buyers and sellers are everywhere. Transactions happen smoothly. But when fear enters the system, something changes. Buyers hesitate, orders disappear, and suddenly the market becomes thin. Imagine Stickman standing at the top of a steep hill holding a heavy ball. As long as the ground is flat, the ball stays still. But once it starts rolling downhill, gravity takes over. Selling works the same way. When prices start dropping, fewer buyers are willing to step in, so the price must fall further and faster to attract the next buyer. This creates sudden gaps in price levels, not because someone stole the money, but because no one was standing there willing to trade. And when markets become thin like this, prices can move incredibly fast. Now we reach the most brutal mechanism inside market crashes. Leverage. Many large investors aren't buying stocks only with their own money. They borrow. A lot. Imagine a fund that buys $100 million worth of stocks. But only $10 million belongs to them. The remaining $90 million is borrowed from a bank. As long as prices rise, leverage amplifies profits. But if prices fall, leverage becomes dangerous very quickly. A 10% drop in the stock price wipes out the investor's entire $10 million. At that moment, the lender intervenes. The bank doesn't negotiate. It doesn't debate the long-term value of the company. It simply protects its loan. The bank demands additional collateral. If the investor cannot provide it immediately, the bank sells the shares. Not tomorrow, not next week, immediately. This is called a margin call. When many leveraged players experience margin calls at the same time, forced selling spreads across the market like a chain reaction. Prices drop. More margin calls trigger. More forced selling appears. It becomes a feedback loop. And in that moment of chaos, ownership quietly changes hands. Assets move from the over-leveraged to the patient. So if trillions weren't destroyed, where did the wealth go? The answer is surprisingly simple. During a crash, money moves into three main places. First, time. Cash is not just money. Cash is optionality. It's the ability to wait while others are forced to act. Investors move into cash because it gives them time to observe what happens next. Second, fortified havens. When uncertainty rises, people move toward assets perceived as stable. Government bonds, gold, sometimes currencies. These aren't necessarily better investments long-term. They simply feel safer when the world looks unstable. Third, strategic silence. This is the most interesting place. The quiet investors. The institutions and individuals who spent years preparing for volatility. They sit patiently while markets panic. And when prices collapse far below long-term value, they begin buying. Not loudly, not emotionally, just systematically. The same companies still exist. Factories still produce goods. People still drink coffee. Search engines still sell ads. What changed was not the business. What changed was the price required to own it. Panicked investors surrender ownership at a discount. Calm investors acquire it. There's one final insight most investors eventually discover. total market value can be vastly larger than the actual money circulating in the economy. Why? Because prices are determined by the last transaction, not by the total money available. If every investor on Earth tried to sell their assets at the same time, prices would collapse long before there was enough money to buy everything. Which reveals a deeper truth. Wealth is not just a number on a screen. It's a claim on future cash flows, an ownership right. And those rights constantly move between participants. So the next time a headline announces, $3 trillion erased from the market, pause for a moment and remember three things. Energy didn't vanish, it changed form. Liquidity didn't disappear, the door simply got smaller. And ownership didn't end, it moved from one set of hands to another. The real question isn't where the money went. The real question is much more personal. When the next crash arrives, will you be the one rushing for the exit? Or the one quietly waiting outside with cash in hand? If you're trading with money you need next month, markets will always control you. But if you're thinking in decades instead of days, volatility becomes something else entirely. It becomes transfer season. I'm Stickman. If this void analysis helped you see the market differently, hit the like button so the algorithm can bring this map to other confused investors. And subscribe because navigating the financial labyrinth is easier when you don't walk it alone. Stay calm, stay liquid. And remember, sometimes the scariest void in the market is simply opportunity wearing a disguise. I'll see you in the next video.